Oil surged almost 10% this week, and Brent briefly traded above $100 a barrel, its highest level since late May. Gold moved back above $4,000, silver bounced more than 4%, but the Nasdaq fell for a second straight week. And now a second inflation threat has joined oil. New US tariffs on dozens of trading partners took effect this week. So is the market bracing for a wider inflation shock? And could the Federal Reserve be forced to choose between inflation and falling asset prices? Welcome to the 2% Brief. If you find this kind of analysis useful, please like the video, subscribe to the channel, and hit the hype button if it's available to you. It genuinely helps more people find the analysis behind the headlines. So let's start with the pricing board. Bitcoin is around $64,065, up just around 0.2% on the week. Gold rose 1.1% to $4,061, back above the psychologically important $4,000 level. And silver gained 4.1% to $58.25, though it remains well below the recent peak above $62. And platinum was flat at $1,600. Oil was again the main story. WTI rose 8.3% to $89.31. Brent jumped 9.9% to $96.78, having briefly traded above $100 for the first time since late May. And the dollar index strengthened 0.7% to 101.5. US equities weakened. The Dow slipped 0.4%, the S&P 500 fell 0.6%, and the Nasdaq lost 2.1%, its second straight losing week. Overseas, the FTSE 100 index gained 1.3%, Japan's Nikkei rose 0.7%, and the Hang Seng advanced 1.6%. Now, oil pushed through $100 because the geopolitical threat widened rather than eased. Iran's Houthi allies in Yemen declared a naval blockade against Saudi Arabia, threatening the Red Sea route that Saudi Arabia has been using to work around the near-total closure of the Strait of Hormuz. That route matters. Saudi Arabia has been shipping millions of barrels a day through a pipeline to its Red Sea terminal specifically to bypass the disruption in Hormuz. If the Houthis can seriously disrupt that route too, one of the most important alternatives to Hormuz would become far less reliable, putting an even larger share of Gulf exports at risk. For now, that is a declared threat rather than a proven closure. Tankers are still moving out of the Red Sea, and Brent eased back to $96.78 by Friday as some of that fear cooled. But both the Strait of Hormuz and the route through Bab el-Mandeb are now facing credible disruption risks at the same time, and that is a genuinely new situation. That backdrop appears to be one reason gold and silver came back into favor this week, helped by bargain hunting after two brutal weeks of losses. Silver often moves more sharply than gold because it is a smaller and more volatile market, though its industrial exposure can cut either way, depending on whether the fear is about war or about growth. Gold's level to watch is $4,000. Holding above it keeps the bullish case intact. For silver, $60 is the level bulls want to reclaim, while a slide back under $55 would suggest the correction still has further to run. None of this, though, happened in isolation from the economic calendar. Initial jobless claims fell sharply to 187,000, well below forecasts, a sign the labour market remains resilient. Flash PMI readings for July beat expectations too, services at 53.6 and manufacturing at 53.8. And new home sales beat forecasts as well at 628,000, though affordability is still under pressure as mortgage rates sit at their highest level of the year. There is also a second inflation threat now. New US tariffs of 10 to 12.5% on around 60 trading partners took effect this week, covering the vast majority of everything America imports. So the Fed is now looking at expensive oil and higher tariffs, pushing in the same direction at the same time. The bigger pressure on stocks came from technology and semiconductor shares. Investors are increasingly questioning whether the enormous spending on AI infrastructure can keep justifying current valuations. The Philadelphia Semiconductor Index is now roughly 20% below its June high. The AI trade is not necessarily over though, but the market is demanding proof, not just promises, from every earnings report. All of this sets up an important few days ahead. The Federal Reserve meets on Tuesday and Wednesday with a decision on interest rates and Chair Kevin Warsh's press conference both landing Wednesday afternoon. Markets currently place a little over 60% on the Fed holding rates steady and a little under 40% on a quarter-point hike. Odds that have moved sharply higher over the past 2 weeks as oil has climbed. With inflation risk building from both oil and tariffs, Warsh's tone on future hikes may matter more than Wednesday's decision itself. Microsoft and Meta report earnings later the same day, followed by Apple on Thursday. So monetary policy and big tech earnings could hit markets within about 24 hours of each other. Thursday may end up being almost as important as Wednesday. That is when markets get second quarter GDP, personal income, consumer spending, and the Fed's preferred inflation gauge, the PCE index. Those figures cover a period before oil's latest surge, so the real question is whether investors treat them as reassuring or as already out of date. Oil tariffs, the Fed, and big tech earnings. Those are the four forces that will decide whether this recent wobble becomes something bigger or fades the way so many others have this year. Now for Inner Circle members, I'll go much deeper on Substack this Sunday evening. The full briefing will examine the scenarios for Brent above and below $100, the tariff impact on inflation, the Fed's real options, and the key levels in gold and silver. You can join the free list or upgrade to the Inner Circle using the Substack link in the comments section or description below. Now if you found this useful, please like the video, subscribe, hit the hype button if you have it, and share the video with someone via social media who follows gold, silver, oil, Bitcoin, or the wider markets. And before you go, watch last week's video on screen now to put everything into context. I look forward to seeing you in the next video and reading your comments. And please, once again, do comment and let me know if there are any specific videos or areas you would like me to cover during the coming weeks, in addition to the regular weekly update. I'll see you soon.